Hi and welcome to Debt Tale. This is Rebecca Bautista and this video is on 5 common credit score myths. So we're just going to be going over some myths that I have commonly heard that kind of surprised me that people believe. But then again, I'm also not surprised because the internet is full of misinformation. And so I hope this video will help clear up some of that confusion for you. All right, so let's get started. Myth number 1, the better the job, the better the score. So I just want to let you know right off the bat that your credit score and your credit report does not account for your job or your income. It is only about what is reported, which are your debts, your payment history, etc. So having a better job does not necessarily mean you are better at handling your debt and finances, and so it is just not a consideration. Also, some other information just for your peace of mind is that your sexual orientation isn't accounted for, your disability, your national origin, religion, because all those other potential factors could create biases. What it does is it just lists the accounts you have at institutions, and even still, it doesn't even tell the amounts of those institutions. When you look at your credit report and you see that it's like, oh, you have a credit card, you have a checking account, you have a savings account, you have an IRA account, it just says you have accounts in these different locations and institutions, but it doesn't even say how much you have. So it just gives a picture of your behavior in terms of financial spending. Myth number 2, which is carrying a balance actually helps your credit score. This is kind of like a half truth. Carrying a balance actually can hurt your score because it will create a bigger credit utilization. However, you can pay off your cards per month, and just as long as you pay it off before the due date, then you aren't paying that interest. So within a 30-day period, if you put in smaller balances, so like auto payments, like your Netflix account or something like that, and then you pay it off before your next statement, then you will actually be showing that you have a good payment history, which will improve your score. Now, if you just have a bunch of credit cards where you have paid them off and you don't put anything on it, then those accounts can look like they're inactive and just lingering, and over time the credit card company may close that account, in which case then that would hurt your credit score. So that's why this is kind of like a half truth, because having a balance shows that you're using the card, which is a good thing, and then paying it off increases your payment history. But by having a balance and just leaving it on, you start accruing interest, and that can actually just financially not be a smart decision. So in that case, credit myth 3, getting married will have your score merge with your spouse. This is absolutely not true. Each individual has a credit score attached to their individual. Again, this is also based on your social security number. When you get married, your social security number doesn't change. That's how they keep track of you across time. And so your credit score is only impacted by your credit decisions. Your spouse's credit score is only impacted by their credit decision. Now, when you apply for a joint loan, that's different, because now the both of you are tied to a loan, in which case that loan is reporting to both of your credit bureaus. In terms of just getting married but you keep your finances separate, it doesn't apply and it doesn't account for anything. They're only impacted if you guys together get a loan. Myth 4, using debit cards will help increase your credit score. Well, this is absolutely false, because a debit card actually doesn't use credit. Even using your debit card in a machine, but then like choosing Visa credit, for example, it doesn't do anything even if you choose credit, because your money is coming out of your checking account and not out of a credit line. So it never gets reported to the credit bureau, so therefore it is never accounted for with your credit history. Meanwhile, with a credit card, it comes out of your available credit, and so it gets added to your balance. Credit myth number 5, the last one, which is co-signing won't affect your credit. This is a very, very big misconception that I hear all the time, and unfortunately I hear it more for older people because they are doing what they think is in their best interest and helping their family out, and then their family member decides not to pay, and then all of a sudden the elderly person's score tanks. Please understand that when you are co-signing on a loan, it means that you are accepting responsibility for that loan as the second person. If the first person does not pay, then you are now financially responsible. Any negative remarks for that loan, such as not paying, late payment, that also affects your credit score because it is linked together, because you are saying you are still financially responsible. Make sure that the person you're co-signing for is responsible, and even if they are not, that you will take over immediately and keep tabs on that, so that way it doesn't negatively affect you. That's it. Those were 5 credit myths. I hope you found this video helpful. If you did, please give it a like. If there are any other topics you would like to get some more information about, leave a comment below and I'd be happy to make a video for it. Please note that I do post on a weekly basis, so subscribe and hit that bell for a notification, that way you know the next time I post a video. I hope you have a good one. Bye.